This chapter 2 summarizes real-life considerations which bring about deviations between market prices of credit risk and the prices generated under the risk-neutral approach. We first list some of the factors that skew credit pricing away from the result under a risk-neutral framework, and then discuss each one individually. These factors are, and this is by no means a finite list, regulatory considerations, tax issues, complexity, liquidity, scarcity, correlation with other assets, membership in indices and in pooled investment vehicles, meaning funds, CDOs, and the like, rating credibility and volatility, risk of a call being exercised, relationship factors and considerations, trading at a premium to par, and finally, duration and convexity. Regulatory considerations can skew the pricing of a credit away from fundamentals, particularly as regards the capital requirements that attach to the particular credit. As an illustration, Basel capital regulation does not always require the same capital charge for two credits that have identical ratings. Differences can arise for identically rated issuers based on whether they are banks or corporates, sovereigns or private sector entities, senior in the issuer's capital structure or subordinated, etc. Other things being equal, the lower the capital charge required under Basel II, the lower the credit spread of the reference entity, especially for those that are held in significant amounts by commercial banks that are subject to Basel regulation. An illustration of how tax factors skew pricing comes from the U.S. municipal bond market. As a general rule, municipal bonds are exempt from federal taxation, which means they can provide the holder with an equivalent after-tax return as comparably rated corporate or U.S. government bonds, despite having a substantially lower coupon. Another example involves securities trading at a discount, for which the price accretion towards par may be taxed more favorably in some jurisdictions than the coupon payments. Other things being equal, of two bonds that have the same credit risk, the one that generates the lower tax liability for the majority of its holders will have the lower pre-tax yield. Complexity of a loan or bond structure and/or complexity of the overall capital structure of the issuer tends to drive the instrument's yield upward. All other things being equal, an investor would avoid a 100-page offering memorandum for a bond that has the same credit rating, maturity, and coupon as another whose offering memorandum runs to 5 pages only, given its simplicity. It is far easier for the investment officer to convince his investment committee to approve a plain bond offering from a well-recognized issuer with standard documentation and legal structure than an alternative involving special-purpose vehicles, derivatives, complex forms of guarantees, collateral, and other credit support, and possibly based in a number of untested foreign legal jurisdictions. And this will be true even when the credit ratings are absolutely identical. Even a bond with an amortizing principal repayment schedule generally trades a little wider than it would if it were a bullet, since it increases the reinvestment headaches and operational bother of the investor. Other things being equal, the simpler the structure and the issuer's financials, the lower the yield. Liquidity is a highly desirable characteristic for most investments, since it implies a greater ability to exit the investment when desired at prices that are close, at least, to the most recent trading price and for substantial volumes. The degree of liquidity an instrument has often derives from some of the same factors we discussed above. For example, more complex securities are generally less liquid, but liquidity differences can also stem from entirely unrelated factors. The most recently issued U.S. Treasury bond of any given maturity, known as the on-the-run U.S. Treasury, is more liquid than the ones issued at an earlier date, known as the off-the-run Treasuries, and therefore the on-the-run Treasury typically trades more than a dozen basis points tighter than its nearest maturity competitors. Large bond issues are obviously more liquid on average than smaller issues. And even two bond issues having the same size may have very different liquidity if one has been placed with, shall we say, 4 large institutional investors, while the other has been broadly distributed around the world among sovereigns, financial institutions, corporates, funds, and retail investors. Scarcity can skew a bond's price and therefore its spread in either direction. If the issuer is an unfamiliar name that has done little to develop a wide educated investor base and to provide frequent updates on its business and financial condition, the market will generally expect from it a yield premium. Conversely, a well-known name with strong brand appeal that simply does not need much debt financing may find itself priced tighter than comparably rated issuers, because investors will realize that there may be few other chances in the near future to access some of this paper. Indeed, the UK government was able to issue in US dollars a few years ago 3 basis points tighter than the US government, principally for this reason, having not issued a US dollar bond for at least a century. Low correlation with other assets in a portfolio increases the appeal of any investment, including that of a credit instrument. It is not uncommon in many markets or market segments to find most issuers concentrated in 5 or 6 industries, which raises investor concerns about systemic risk and drives the quest for diversification. The European high-yield bond market, for example, was heavily concentrated in its early days around the telecom sector, giving rise to attractive opportunities for comparably rated issuers from other sectors to sell bonds at substantially lower yields on account of the massive investor demand for issuer and industry diversification. Similarly, the majority of issuers of floating rate notes, or FRNs, in the US tend to be financial institutions. So the occasional issue by a well-rated industrial is greeted with tremendous investor demand. Membership in an index tends to tighten the spread of an issuer, since it ensures heavy demand for its paper from funds and portfolios that track this index. By the same token, spreads often widen abruptly when an issuer is removed from an index, often beyond fundamentals, since this is followed by heavy selling pressure from trackers. This phenomenon is not limited to issuers appearing in indices. For example, when the CDO market is booming and comes to represent a large percentage of the demand for certain credit instruments, names that are commonly included in CDOs, for whatever reason, tighten more than ones that are not. Investors often disagree with the rating assigned to an entity and its paper, and drive pricing far away from that of similarly rated paper. In one sense, this factor is different from the others we have listed so far, since the wider or narrower pricing can be justified on the basis of a disagreement between the agencies and the leading investors regarding the default probability and recovery value of the instrument, i.e., the two fundamental factors that appeared in our pricing model previously, with the wider or narrower pricing reflecting more bearish or bullish credit views, respectively, on the part of the investors. A related matter involves ratings that are expected to be more volatile than others. For example, it is now known that subordinated tranches of securitizations experience greater ratings volatility than comparably rated corporate paper due to, first, the inability of the SPV issuer to take remedial actions in response to the credit deterioration, given the limitations on its activities, and second, the technical reality that once a subordinated tranche's credit enhancement has been exhausted, it takes a short time only until that tranche is wiped out altogether, given how thin, as we say, it is as a percentage of the overall capital structure of the SPV. If you are not familiar with these notions from the ABS market, they are discussed extensively in our modules on asset-backed securities. Turning to call risk next, some bonds are callable while others are not, and the same is true of loans. In principle, the coupon for callable debt is adjusted upward to reflect the fair value to the issuer of the call option he has retained, so that the higher coupon may not necessarily reflect a deviation from the fundamental pricing equations we have been considering. In practice, however, many call provisions are triggered by conditions that are very difficult to model, such as a call that can be exercised if the capital treatment of a security is modified by a regulatory change, or one that is triggered if the withholding tax applicable to the coupon payments increases due to new legislation. In general, paper that appears to have greater exposure to these types of call risks will typically trade at a yield premium to paper that does not, over and above the premium that can be justified by the fair economic value of this call. Relationship pricing is particularly common in the syndicated loan market, where banks are often willing to price loans tighter than required by fundamentals to earn the goodwill of the borrower and win other business from it. This often causes loans to be priced tighter than bonds with comparable terms, since relationship considerations play a smaller role in the bond market. Bonds trading substantially above par will typically find their spreads widening beyond fundamentals for a number of reasons. For one, the premium above par presents funding difficulties for an investor who will have to pay the purchase price but receive only the lower face value at maturity, complicating that investor's asset liability management process. Perhaps more importantly, in a bankruptcy of the issuer, the investor's claim will be limited to the bond's face value, which means the holder of the premium bond will incur greater losses than holders of paper trading at or below par. To illustrate, assume an issuer has 10-year bonds outstanding with alternative coupons of 10% annually for the first bond and 6% annually for the second bond, and that both these bonds have identical seniority. If the market is demanding a yield to maturity of 8% to hold either bond, the price of the high coupon bond will be 113.42% relative to par, while for the low coupon bond the price will be only 86.58% relative to par. You can confirm these numbers using the PV function in Excel. And yet, in a bankruptcy of the issuer, and assuming the two instruments have the same legal seniority, the two holders will be allowed to enter a claim in that bankruptcy process for the same par value of 100, and will typically recover the same amount despite the very different prices that they paid for their investments. This naturally diminishes the attraction of the high coupon bond, pushing down its price and increasing its yield. Finally, the duration and convexity of a bond can push its spread away from comparable paper with the same rating and economic characteristics. In markets in which pension funds and insurance companies represent powerful players in the bond market, long-dated paper tends to trade at a price premium and therefore a tighter spread, given the high level of demand for long duration to match the liability profile of these entities. Often this results in yields on very long-dated paper dipping substantially below the yield on paper by the same issuer with short or medium tenors, especially in the case of sovereign issuers. Bond convexity is also a desirable quality for traditional investors, since it provides a certain level of protection against portfolio losses when rates move abruptly. So, other things being equal, the more convex a bond, the tighter its spread. For both duration and convexity, you may recall from our modules on bond mathematics that these characteristics are highest when maturities are long, coupons are low, and market interest rates are also low. You should have realized by now how numerous are the factors that influence spreads and drive them away in either direction from the result generated by our risk-neutral framework. At times, these influences become so paramount that the pricing models we used earlier, based on only the two fundamental characteristics of default, probability, and recovery value, produce spreads that bear no relation to market reality. While this complicates enormously the problem of determining whether a credit instrument is fairly priced relative to its fundamentals, it also presents excellent opportunities for those able to undertake the analysis to uncover value by splitting an instrument's yield between its fundamental factors on the one hand and the technical factors that we have described in this chapter on the other hand. This is the end of chapter 2.